This is Barry Zalma speaking for Claim School Incorporated with a true crime story of insurance fraud. The videos I produce in this series were produced so that you can learn how insurance fraud is perpetrated and what is necessary to deter or defeat insurance fraud. This video blog of true crime stories of insurance fraud with the names and places changed to protect the guilty are all based upon investigations conducted by me and fictionalized to create a learning environment for claims personnel and anyone else involved in insurance. Today's case is called the Hawaiian. The insured was a contractor in Honolulu. He made an excellent living cheating his customers. The insured's most lucrative scheme was an electronic vermin killer. It consisted of a long wire and a transformer. The contractor strung the wire around a house and plugged it in a wall. The device charged with low voltage from a transformer allegedly repelled vermin. The insured guaranteed that all roaches, flying insects, and rodents could not pass the charge in the wire. When it didn't work and a customer called to complain, the insured would ignore the complaints. Since the tropical Hawaiian climate is a prime breeding ground for insects, the insured had no lack of customers. He bought a Ferrari sports car with the profit. Eventually, the Attorney General of the state of Hawaii learned of his fraud. Investigation showed that the vermin killer did not work. Eyewitnesses reported cockroaches dancing on the wire unharmed. The Attorney General filed administrative charges accusing the insured of consumer fraud. The local press published reports of the charges and his sales began to drop. He needed cash flow. The insured went to the most expensive jewelry store in all of Honolulu. The store occupied the 15th floor of a high-rise office building. To enter, he needed to show identification to a guard and pass through 2 steel doors. He bought a single wristwatch at the jeweler, charged it on his American Express card, and asked the jeweler for and received an appraisal of the wristwatch. He then visited the local public library and withdrew 3 books on gemology. He returned to his office and made a Xerox copy of the appraisal. He then covered the description of the wristwatch with a large Post-it note. He photocopied 20 new copies of the appraisal. The Post-it note was invisible to the Xerox machine, and he had clean appraisals with no descriptions. Using the books on gemology, he wrote out descriptions for 45 separate items of ladies' and men's jewelry. He set values beside each item so they totaled over $500,000. He gave the blank appraisals to his secretary and had her type up the descriptions and values he had written onto the appraisal forms he had created. He then made 2 copies of the new appraisals and destroyed the originals. Armed with his appraisals, he visited a large retail insurance brokerage in Honolulu. He advised the broker that he had recently acquired the jewelry from his deceased mother and needed it insured. The broker was familiar with the jewelry establishment that had written the original appraisal for his watch and its impeccable reputation. He accepted the Xerox copies of the appraisals, prepared an application, and submitted the application and appraisals to various insurance markets. He received quotations from 3 different insurers. Each agreed to insure the jewelry. The insured selected the insurer that offered the lowest premium. He explained to his agent that he had a slight cash flow problem, and the agent helped him by financing the premium. He made 1 payment on the premium finance contract and then reported a theft. He advised the insurer that the jewelry was secured in the locked drawer of his office, which he considered to be a safe. His office was a small structure with a warehouse facility where he parked his construction truck. On that night, also, the Ferrari. It was an employee's birthday, and he and 5 employees went to a local restaurant to celebrate the birthday. Since they could not fit in his Ferrari, they all went in the foreman's 8-passenger van. When they returned from the birthday party, they immediately noticed that the Ferrari was no longer in the warehouse. The aluminum overhead door was off its track. Someone had broken in. The thieves must have found the keys to his Ferrari in the desk. The desk drawer was broken and on the floor. No jewelry remained in the building. The insured was distraught, since the jewelry was his only connection with his deceased mother. He demanded that the police do everything they could to catch the thieves and return his jewelry. He told the police he did not want insurance money. He only wanted his family heirlooms back. He even asked his insurer to offer a reward for the return of the stolen jewelry. The insurer, faced with a $500,000 loss, assigned their most senior investigator to the claim. He agreed with the insured and offered a $50,000 reward for return of the jewelry. He then began his investigation with a recorded statement of the insured. Besides advising the investigator of the theft, he informed him that his mother had mailed him the jewelry shortly before her death. She died 4 years before in a small village in the Philippines. She was afraid that the Philippine government would take the jewelry for taxes. To avoid those taxes, Mother had simply packaged them in a plain brown wrapper and sent them by mail. She did not insure the delivery, nor did she register or declare to U.S. Customs the contents. He kept them in his home for safekeeping until her death, when he believed they had become his property. Then he took them to the jewelry store to establish the value of the gift his mother had made to him. He was astonished that the jewelry had as great a value as reported by the jewelers. He immediately took steps to insure the jewelry. 2 days after the theft, the police found the Ferrari in a gully. Since it was only one of 8 Ferraris on the entire island, there was little the thieves could do with it. The police believe the thieves set it afire. The police found only a burned-out hull and no evidence available to lead them to the thieves. The destruction of the Ferrari seemed to establish the legitimacy of the claim. The adjuster began the steps to complete what might be a routine investigation. His first stop was at the jewelry store. He found the gemologist who signed the appraisal. "That is our appraisal form," the jeweler stated. "That is a copy of my signature. I have no record of ever doing this appraisal. I have no recollection of ever doing this appraisal. I have no knowledge of the person with the name of the insured. That isn't unusual, however, since I do 1,000 appraisals a year." "Do you have your filed copy?" the adjuster asked. "That is what is strange," the jeweler replied. "I can't find the copy. But my secretary, just about the time of this appraisal, began chemotherapy treatment for cancer. She's dying, and I can't disturb her." The adjuster had a logical explanation for the failure to verify the appraisal. He could not, however, let it sit, as a simple, straightforward theft claim was becoming complicated. The adjuster next had a friend who works the South Pacific attempt to verify that the insured's mother did in fact live in a village in the Philippines described by the insured. That investigator was successful. He found neighbors and relatives who knew the insured's mother. He could not, however, verify that she had $500,000 in jewelry to donate to her son. In fact, he found that the insured's mother lived in a one-room house on stakes with a grass roof. No electricity, no running water, and no indoor plumbing. Her ex-husband, however, still lived in Honolulu. The insured's family name was unusual in Hawaii, and it only took the investigator 2 days to find the insured's father. The father lived in a basement apartment in a rundown area of Honolulu. He was pleased to give the adjuster an interview. He had been estranged from his son for 20 years and his wife for 10, so he had no first-hand, up-to-date information. He did acknowledge that his wife owned jewelry. He told the adjuster, "Yes, I believe it was very valuable jewelry she owned." "How much do you think it was worth?" the adjuster asked. "Oh, at least $500 to $600. The adjuster began his investigation in earnest. He invited the insured secretary out to lunch. Over a chef's salad and a glass of iced tea, he learned the secretary's life story. He knew she had been in Hawaii for only 2 years, having come to the islands from Iowa. She was young and very innocent. She liked her job, but made only enough money to survive in the islands. She could not believe the cost of housing compared to what it had been in Iowa. After gaining her confidence, the adjuster confronted the secretary with the result of his investigation. He told her he knew that the appraisals were not done by the jeweler. He showed her where he had discovered that the typewriter used to type the description of the items of jewelry was different from the typewriter used to type the name of the appraiser. He told her that he liked her and would be very sorry if she was involved in aiding her boss in committing a crime. She began to cry. When he calmed her down, she confessed that she had typed in all of the descriptions and the values of the jewelry. Her boss, the insured, took the print ball out of her old IBM Selectric typewriter and smashed it under his shoe. If asked, she was to say that his children broke the typewriter while playing with it. The adjuster thanked her, paid for lunch, and suggested she get a new job. He told her he would do what he could to keep her out of criminal proceedings. He then got permission from his client, the insurer, to deny the claim. He wrote a simple, brief letter to the insured stating as follows, quote, "Your claim is denied because it was presented by you with the knowledge that it was false and fraudulent." His letter said nothing more. The adjuster, as required by law, reported his findings to the local police agency and to the U.S. postal inspectors. Both promised to complete a prompt criminal investigation and prosecute the insured for insurance fraud. The adjuster waited patiently for 5 years. Every 12 months he would ask the police concerning their investigation, and he would always receive the same response: "We're working on it." On the 5th year, just before the statute of limitations ran, they arrested the insured for insurance fraud, wire and mail fraud. On the testimony of the adjuster and the secretary, the insured was convicted. The court sentenced him to 5 years in jail, suspended, on the condition that he actually served 30 days and that he make restitution of $10,000 in investigation costs to the insurer. 5 years elapsed since his conviction. He still is making a living as a contractor in Hawaii, defrauding his customers. He paid when the probation officer caught him what he told the probation officer he could afford. In 5 years, the insured paid on the restitution order that is a condition of his probation a total of $250. Once his probation was over, he stopped paying. The crime did not succeed. He did not collect $500,000. The insurance company's work did not succeed. It paid out over $10,000 to its investigators and lawyers, which it will never recover, and the ordered restitution was never paid. This video was adapted from my book, Insurance Fraud Costs Everyone, which is available as both a Kindle book and a paperback from Amazon.com. Thank you for your attention.